Merrill Lynch Global Research. And Michael, I'll start with you. Is the market totally disconnected from the underlying economy? 280,000 jobs sounds pretty good. That sounds like 17,000 on the Dow to me, no?
Yeah, I don't think it's totally disconnected. I think that you're seeing signs that the economy is showing a little more health. Obviously, the first quarter GDP growth was quite weak, but a lot of the other data during that time of the year, I mean, even payrolls weren't that weak. You had auto sales were strong, you had industrial production was strong. There's a lot of indicators that show that the economy was not contracting at 3%. And I think the market sort of smelled that out.
So you don't think that this is just a Fed-orchestrated asset bubble in the stock market?
It's having some impact, but I mean, the simple fact of the matter is the economy is looking better, and I think the stock market smells that out.
Hey, Paul, 17,000, is that the high end of a range for the next year, or are we going to be at 18, or not, make it 2 or 3 years, or are we headed 18, 19, 20,000? Which is it?
So I don't think 17,000 is the end. I think we are a ways away from the bull market ending, and a lot of things are going to happen before the bull market ends. One of them, Joe, we haven't even had a pullback yet. So a modest 4 to 8% pullback, which should lead eventually to a correction of 10%, which eventually will lead to the end of the bull market. We haven't had the pullback yet. So the bull market still has legs. People hate it, they disavow it, they want to throw it away and cast it aside and rationalize why we shouldn't be where we are. The bottom line is there's still no other place to put your money. And people talking about the bubble and the preponderance of professionals saying that the bull market's got problems, it can't last, that's going to fuel further gain. So we hit 17, it's only a number, 18 is next for sure.
All right, so down 2.9, what will this quarter be? What will the third quarter be?
We're looking for 3.4% right now in the second quarter.
3.4, and then back below, will it come down in the?
Yeah, we think down a touch to about 3% for the second half of the year, but basically growing a bit above trend for a change.
That would count for 3% in a lot of people, but even with the -3 in the first.
Yeah, I mean the year as a whole is going to look very good, right? The year as a whole is going to look around 2, or probably a little bit below 2. Right,
but it doesn't matter if the run rate is,
that's right, the trend
3
is
or above.
That's right.
That would be enough.
Momentum.
That would be enough to justify 17 times earnings or 18 times earnings, wouldn't it be? With 0 interest rates, anyway.
Pretty close, and we'll be there for a little while.
And when do we see the first? When do we see it move up?
I think it's going to be late next year.
So not early 2015.
I think it's unlikely at this point. The Fed is in an asymmetric situation, right? They've got a lot of tools if they need to hike. They don't have a lot of tools if they need to ease any further. Right? I think they're going to err on the side of caution.
Are they still, for a while, in both jobs and inflation, they could say we need more accommodation. They could say inflation's below target, employment's still not where it should be. We can do it on both ends. Are they at a point now where they're just working on employment and they're starting to say, wow, inflation is...
It's getting closer. I mean, we're healing, but we're not healed from the Fed's perspective, right? And I actually think there's a chance we could overshoot a little bit on the inflation target for a time. We've undershot for a number of years.
So what, like 2.5 or something?
I think 2.5 is on the high side, 2.25-ish. Yeah, I think that's quite possible. I mean, it'd be higher in the CPI because obviously they're targeting the PC and not the CPI. There's a bit of a gap between the two.
Okay, Paul, you've heard about profit margins being at all-time highs. How are we going to get corporations to get the next step up in profits? Are they going to build some plants? Are they going to hire some people? Are they going to spend some money? Or are they going to just continue to try to increase productivity?
It's going to be more of the same, Joe. This is your typical post-financial crisis recovery. It tantalizes a little bit on the upside. We get a little worried on the downside, but it's like walking in a lot of heavy mud for a while. This is typically what happens, go back in history, after every financial crisis. Until you get to the other side of the next recession, nothing is going to really change in corporate America. So we're stuck where we are, and let's remember, all these tax increases over the past couple of years, they have come to roost. It's still dragging down the economy a 10th of a point here and a 10th of a point there. I think it's a little naive to believe all of a sudden we're going to have 3% plus growth year over year for a couple of years. I think we're in the later stage of the recovery. It's not a great recovery, but it has been a recovery.
It's been a long recovery, and none of the signs that would indicate some type of looming slowdown are here right now. It'd have to be something exogenous, I guess, some kind of geopolitical event, oil, something like that.
But isn't it always? I mean, you can look back, and there are slowing signs. In each recession, there are signs before that they slow. But in a normal economy, they actually pick back up, and there's always some shock that comes. So, of course, there will be, listen, when the bull market ends, there's going to be some kind of shock that people are going to say, oh my gosh, the bull market ended because of whatever geopolitical event happened. But there's always some event. So I would argue that at some point next year or in 16, we'll have some event again.
Okay. All right.
But where else are you going to put your money? You have nowhere else to put it. You're not putting it in your mattress. You can put a little bit in the bond market for sure, but there's nowhere else to go.
Okay. All right, guys. Thank you. Appreciate it.
Thank you. Have a great day.
You a Djokovic or Federer guy?
I'm a Federer guy just because I'm a sort of hopeless romantic, but I thought it was great to see him win. Djokovic, that is.
Did you see there was an overhead smash that if Federer had hit it, he would have gone up in that fifth set, and he would have looked like he was going to. We were watching closely.
Well, yes, he had a shot then, and he also had a shot early on in the was it the second set?
Well, it was only the fifth set that mattered. And,
no, I know.
And they got he had a chance where he could have been up 15-30 and with Djokovic serving, and that was and he had it, and it just and I said, it's weird that 5-set matches you can really see momentum in like
one. But I do remember when you used to watch Federer. I remember going to see him at the U.S. Open. It was, even though he was so great, it was almost boring to watch.
Well, he never made mistakes.
Because he was so good
with his forehand.
And it was just you saw.